Hi, everyone. I'm Christopher Thornycroft with Redwood Logistics, and welcome to the Redwood Rundown for the week of October 16th, 2023. We are making our way through our month. We are almost to Halloween. The scariest thing that I see every single week is the Bears offense. Man, sorry about that, everyone. Actually, I have no idea what to be for Halloween this year. I'm trying to figure this out. Send me some suggestions. Anyway, other things that we're talking about. We are talking about what's happening out there in the freight market. Let's get a little specific first. What are we seeing? We're seeing a little pickup from Southern California. Last week, at the end of the week, we saw Southern California, Los Angeles market over 4-1 on both Thursday and Friday. Really raised our eyebrows. It wasn't what we were expecting. Then yesterday, we saw Southern California, Los Angeles market at 4.8-1. Now, when we see Southern California move in that direction, we're generally watching for what are the other signs that tells us that this is real. One of the big signs that we watch is, does Phoenix move with that? And Phoenix load to truck ratio yesterday popped all the way up to 2.7-1. Today on the floor, moving freight out of Los Angeles was actually one of our tougher spots to move freight out of, and it hasn't been in the past. Overall, though, truck pressure goes since going all the way back to April. So again, a surplus of capacity, but we are starting to see more of that capacity pulled out. We saw carrier authorities down by 728 authorities week over week last week. So we think that pace is going to accelerate as contract rates go down. Why did everyone miss when they were trying to predict what was the reason why there wasn't enough capacity exiting the market early to push the freight market cycle the way that we thought? Well, everyone can speculate back and forth, but really the answer is no one was really looking at how much of that freight was in contract, which was paying significantly more than spot. Now, as we're seeing contract rates come on down and spot, and we're seeing the dislocation of networks caused by the UAW strike, etc., yes, we think that we're going to see capacity exits continue to accelerate. Keep a very close eye on inventory levels. So with that said, total business inventory to sales ratio down from 1.39 to 1.37. Merchant wholesale inventory to sales ratio. Numbers came out today, down from 1.39, really high, near the record of 1.41, to 1.36. For the freight recessions that we've seen in the past, the average for merchant wholesale inventory to sales ratio has been about 1.35, 1.36. It starts to really create a spot market once we get into the 1.3-1 inventory to sales ratio. Now, we know that people are going to operate lean, but I'd say that every single time people start to say, no, we've got inventory under control and we're going to be operating differently this time, and that's what we've been hearing a lot of this, it's going to be different this time. Watch for the same to happen. That's all we've got for this week. Take care, everyone.